Hello and welcome, everybody. Good to have you all here. We appreciate you making time for today's webinar, 4J Wealth's Market Update. We thought we would do a little bit of a different format today with Jeff and I both speaking, presenting, and then answering your questions. We're really excited for this webinar. The team put in a lot of work and we have a lot of ground to cover, so we want to get started. But before we do, we just want to cover a couple housekeeping issues. So if you have a question, we want this to be as interactive as possible. If you have a question, just put it in the Q&A box. You can click on that at the bottom, type in your question. We will receive that question, and then in the last 15 minutes, we're going to answer any questions, and anything we don't get to, we will follow up via an email. So we are very excited about this. We hope that you enjoy it and find it valuable and timely. Let's go ahead and get started. So what we'll start with is American exceptionalism, what that means, how that's developed over time, and then move into kind of more current policy things that are going on, like tariffs and explaining trade deficit, then moving into the economic impacts, what's going on with the markets, and then challenges and opportunities as we see it today, and we'll finish with the Q&A portion. This is our team. Everyone had a hand in today's webinar and putting together the information, so we hope you enjoy it. So first off, right, in order to think clearly and rationally, we want to always be operating from a place of calm. So, it is a stressful time to be an investor. It's a difficult time to be an investor. So we want to start with just settling the nerves, taking a deep breath. So where we're going to start is with American exceptionalism, which is something that's been in the news lately as something that's under question. But the story of America's rise to global dominance is something that's developed over really the past century, not the past 10 or 20 years. Our GDP was 2% of global GDP in 1800, and we actually reached a peak of 60% of global GDP in 1960. And today, our country, the US, has a global GDP representing 25% of that of the world, despite only having 5% of the world's population. Our military strength helped secure victories in both world wars and has supported a post-war global stability, kind of democratic world order. And that's the underpinning of that is really the US dollar. Still 80 to 90% of trade is settled in dollars. And of all of the central banks around the world, their currency reserves, 60% of those approximately are in US dollars. That gives the US significant influence and power throughout the world. Our innovation continues to lead, whether it's the internet, AI, space exploration. America continues to innovate and lead. And as a result of this, right, for the last 50, 60 plus years, we've enjoyed very good standards of living, fairly low inflation, and long periods of prosperity, right? We're a wealthy country, and the world kind of looks to us for direction and for help when needed. And the market is a very good kind of measuring stick in the long run. And over the last 16 years, you can see how U.S. exceptionalism has played out. Right, this is a chart that's looking at the S&P 500 relative to basically the world market, excluding the US, and then also emerging markets. And you can see the US over the last 16 years has returned about 5+ times what stocks have returned outside of the US. And I think this is more a reflection of the substance of US exceptionalism, US innovation, and really in the last 10 years, especially the dominance of US big tech. We talked about US innovation. We can measure that through the number of patents that are getting issued. And I think the thing to focus on here is to get from 4 million to 5 million patents, it took 14 years. To go from 10 million to 11 million patents, it took only 35 months. So not only is innovation alive and well, but it's actually kind of accelerating over time, which is a big reason why the US continues to be a leader in technology throughout the world. So the question that's come about as a result of recent actions that have taken place and some of the sell-off we've seen in technology within America, technology stocks, is can this American exceptionalism continue, right? So China, they clearly are a world power, and their rise has challenged U.S. global leadership. There has been, right, a trend over the last decade where central banks are still buying US dollars, but on the margin, they are diversifying into other currencies, right, including gold. One of the issues that the news is talking about a lot, pundits are talking about a lot, is our debt, right, our deficit and our debt. And we continue to run a very high federal deficit, 6 to 7% of GDP, which really historically was something you saw more during recessionary environments, and now it feels like it's just pretty standard. And a pretty large amount of that, right, 1.3 trillion, is going to just annual interest costs. Our federal debt to GDP ratio, which is something that many investors and economists look at to see, okay, how sustainable is this debt load, has grown to levels that are concerning at 120% of federal debt to GDP, which is the highest outside of a brief COVID spike when we had to print a lot of money to deal with the COVID situation. So it is concerning. However, I think we're going to talk a little bit more about the whole story and how we've gotten to this point, right? Because it doesn't happen in a vacuum. And we do have large trade deficits, right? And China is the one we run the largest trade deficit with. So if we have enough of a global economic rebalance, which is pretty much what the US is trying to do, it has the potential, not necessarily, but the potential to weaken demand for US dollars and assets. That impacts valuations, that impacts inflation, it impacts interest rates. And we're going to talk about, again, why that would happen, why that could happen, right? Why could it be bad? And this is just looking back since the 60s, tracking US debt to GDP, right, as a ratio. And as you can see, other than COVID, it's at the highest level today than it has ever been, barring World War II. And really, you could see the dramatic jump happen as a result of the great financial crisis, right? The great financial crisis was in here. We had a very deep and long recession. Equity markets during that time period sold off, 50, 60%. And look at the rise in the debt to help deal with it, right? So you had a dramatic rise in the debt that kind of continued to rise. It leveled off in the late teens, and then COVID resulted in a dramatic spike again came down, leveled off, and now we're on the rise again. So it's clearly not a sustainable trajectory. It's not, in our opinion, something that's urgent, but it is important that we address. It's not an emergency, but it is important that we address it. And I think that's what is there's some goal of that. They're trying to do that now. We'll see how successful it is. So this is just a quick snapshot. The black is the amount in trillions of dollars that central banks around the world hold in US dollars. And we're going to come back to this, but obviously it is the most significant currency that central banks hold around the world. And that's really important to remember when we get into talking about trade and how it really works. So we're going to now move into trade and tariffs, both past and present, to help give you a framework to think about what's happening in the world today. So obviously, we've had a trade deficit for a long time, right? And so since the 80s, we've had a trade deficit. It actually was much worse in the mid-2000s, but still, nevertheless, we run a trade deficit. Now, what does that mean? right? It means we spend more importing other people's goods and services than we do exporting, right? So we're sending out more dollars than we're receiving back in foreign currency. So there's a trade deficit to us. It's a trade surplus to our trading partners. Okay. So Warren Buffett in 2018 in the CNBC interview, and we're gonna pick this apart, this what he said here, because it's there's a lot of punch in basically two sentences. But what he said is on trade deficits specifically is you're giving up plain checks on our country essentially in exchange for having more consumption now than what you're producing. So eventually they, meaning foreign countries, have claims on our US wealth. So do we want policies where the overall trade, so we do want policies where the overall trade deficit doesn't get out of hand in relation to GDP. Okay. So what does all that mean, right? That kind of sounds a little bit esoteric. So we really want to break this down. So the first thing here is just to understand that US share of manufacturing jobs has been declining basically since World War II. And it's been at an extremely low level since the early 2000s. And the reason for that is because China, right, is a manufacturing powerhouse. And so the way the economics of this work is if we can have China, or if China can manufacture things at a significantly lower cost, they can have specialization, they can do it well, they can do it on time, and they can do it cheaper than us, then we'll gladly kind of export that manufacturing. The world will, in fact, because, right, that makes a better use of our resources to invest in other things. So this is kind of a natural part that's occurred of globalization, where you have some countries, right, that are doing more of the unskilled labor work, which helps to keep costs of living low, right? It does have benefits, but it has come at the expense of certain sectors in the American economy, especially manufacturing, and that's hit the Midwest, the Rust Belt especially. So this is something that's developed over a long time, and we're gonna again kind of dissect this. So why do foreign countries, China, countries in the Eurozone, Japan, why do they hold US dollars? So let's just take it there. You have a Chinese merchant, they sell a good, stuff. We buy that good, we pay them in dollars, but they can't take those dollars and go spend them in the Chinese economy. They need to convert it to the local currency. So how do they do that? They give the dollars to the banks, right? And then and banks go to central banks, but they go to the banks. So the banks hold the dollars, give them the local currency. Well, what is the central bank and these banks supposed to do with those dollars that they have, right? What they do and what they have been doing is buying US assets, namely US debt, Treasury securities, right? That's the IOU, right? They're buying US securities, US Treasuries, which say, hey, we have to pay you interest, and then eventually we have to pay you this money back. Why do they do that? One is the US dollar is far and away the most liquid, right? Treasuries are the most liquid market in the world. I believe it's a market of about 27 trillion. It's generally regarded as trusted, and it's easy to spend worldwide. Now, an alternative would be to sell dollars, right, convert it into their own currency. What would happen if they did that? If they dumped a bunch of dollars and bought their local currency, they're going to weaken the dollar, increase their own currency. That's going to hurt their economy because they're not going to be able to export it to us, right? That everything's going to be more expensive. What are the other alternatives? They could put it in the euro and the yen, but both of those have issues as well. And the Chinese yuan is not fully trusted. So this idea of, oh, we have excess dollars, we're going to dump them and buy gold or whatever, actually is kind of a negative economic cycle for them, right? It's a vicious cycle to them because it hurts their currency, right? Or excuse me, it hurts the dollar's value, which makes them exporting to us less competitive. And they're very dependent upon us buying their goods for their economy to thrive. So Buffett talked about claim check, right, which is kind of is an IOU. So why is paying in dollars still like an IOU? So let's talk about this. So we pay for the goods with dollars, right? And we talked about in the last slide, those foreign countries are almost basically forced, right, de facto to save those dollars, right? And so they only have so many choices. So far and away, the most liquid place for them to put it where they can earn interest is the US Treasury market, right? So they're lending money back to the US. So the Treasury bonds they buy are IOUs that the US must pay later with interest. So even after paying for the goods, which is this is kind of odd, we've paid for the goods, so why is there an IOU? It's because they have a surplus, they're then buying our debt, so we then owe future payments to those foreigners. So that's kind of the genesis of the trade deficit, and how it results in kind of this circulation where they repurchase dollars, own more of our debt, but it's for good reason, right? It's because it's the safest, most liquid, deepest market in the world. So we have a real privilege in the US, right? An exorbitant privilege, some might say, which is the world's trust, okay, in the dollar lets us borrow cheaply, run big trade deficits without a crisis, and we have high standards of living with less pressure to balance budgets. That doesn't mean at some point it can't reach a point of no return. But what it means is, I remember Reagan in the 80s talking about if our debt hits $1 trillion. Well, the debt is so much more than 25, 30 times that now, and we still haven't had that crisis. And it's because of this, right? It's because people don't really understand how trade deficits work, why foreign central banks still do buy dollars, despite the rhetoric you might hear. It's because they're kind of forced to, right? And no other country has this same luxury. So that trust in the dollar lets the US live beyond its means without immediate pain. So now, of course, right, what we're seeing today is a lot of concern over global trust in the dollar weakening. Okay. And so is that happening? The answer is it is, right? It is happening, but it's been happening. It's been happening slowly over time. And in fact, right, yes, central banks are buying more gold. They are buying other currencies, right? The US debt is growing fast. It's at too high a percentage of GDP, and that's concerning, which is why you're seeing longer term treasury yields tick higher, in our opinion, right? There's more of a premium that we need to pay. It's still reasonable, but it's going in the wrong direction. But again, the reason it hasn't blown out is that there really still is not a good replacement that exists. So the dollar remains dominant, right? It still is quite stable. So here's kind of the yes, global trust in the dollar is weakening, but look at this. From 2000, right, US dollar share of global reserves represented 71%. 25 years later, it's at 58%. So has it come down in the last 25 years? Absolutely. Is it a material amount? Yes. Is the level still put the US in a dominant position relative to the rest of the countries in the world? Yes. And here's the first question for you guys. What do you think the next biggest global foreign exchange reserve is? And what percentage is it relative to the total share of global reserves? I'll let you guys think about that. You can think in your head. You can type it into Q&A if you want. But I will now answer. The answer is the euro is the next largest reserve currency, and it's at 20%. 20% is the next largest currency. So between the US and Europe, that's almost 80% of global currency reserves. So again, are things maybe changing in the margin? Yes. Is anything going to change very soon? We think it's highly unlikely. All right, Jeff's gonna get going here. Do you want to control this or you want me to? Okay.
Okay, I mean, obviously the last, I would say, couple months, probably since maybe January, February timeframe, tariffs have been in the news quite a bit. For many of us, we've had to sort of dust off the old econ textbook and just do a little quick refresher. Um, the reality is, tariffs have been kind of used in this country for a variety of purposes over, basically since the founding. Even though the founders were kind of pretty much pretty big proponents of free trade, there were elements that were kind of they were constrained to raising a lot of tax revenue through income taxes. So tariffs, duties, all of those things on imports were a good way to sort of circumvent kind of displeasing the local population. And so for the first period of history, really in this country, tariffs were, raising about 100% of what the government's kind of federal government's tax receipts were. That slowly declined to about 50 to 70%, during the 19th century. And then ultimately we got to a period, the 16th Amendment was passed in 1913, which kind of established the IRS and the income tax. And then really what we saw is tariffs as a percentage of federal revenue really declined precipitously. There's a brief period, obviously, in the 30s with the Smoot-Hawley Tariff Act. And then we have World War II. And then really after World War II, 1947, 1948, we kind of introduced the General Agreement on Tariff and Trade, which kind of really removed a lot of those tariff barriers and kind of liberalized trade. And we saw kind of a period where there's we went from pretty significant amount of tariffs that were in place to about the effective rate of tariffs about 1.5%. So it's really not kind of a revenue generation tool, after basically the 1940s. But I would say also, the second reason for why tariffs kind of do come in and out of sort of public and political discourse is pretty much the second bullet point, which is protecting domestic industry. A lot of what's happened over the last, couple months in terms of, should we protect, raise tariffs on steel and autos, and all of those things, feel like they're new, but really they've been going back. Bush talked about raising tariffs on steel. Reagan talked about raising tariffs on steel. Nixon talked about raising tariffs on steel. So there's, and we go back into even the 19th century, the North was industrialized, the South was agriculture. So there was kind of a lot of tension, between those two sort of economic cohorts about, should we have tariffs, should we not have tariffs? So the last part I would say is, and kind of where we are now, is tariffs have been used as a way to kind of, as a sweetener, a carrot, or sometimes a stick. And the reality is right now, Trump is sort of using all tariffs as all three. Again, this is kind of going back to my point. The tariffs, typically, 100 years ago, 100 plus years ago, would be a significant amount of federal revenue, but also the tariff rate was pretty substantial. After 1948, that rate kind of declined pretty significantly. We've had a kind of a series of trade acts that have helped kind of reduce some of those barriers. 1994 was when NAFTA kind of came into effect. The WTO was established in 1995. China joined the WTO in 2001. And then you kind of seen recently in the last couple of years kind of an uptick where that gold circle is with the dotted kind of red is kind of the effective tariff rate that would be in place, if the tariffs at the current tariffs kind of remain in place for a period of time. This is going to be a significant price adjustment, I think. And we've kind of increased tariffs back to the highest level in the last probably 80 years or so. So this is a substantial departure from the last 60 plus years in terms of trade. The state of tariffs today, it's easy to kind of get lost in what's happening. It feels like it's been quite a whirlwind over the last couple of months. We could go through the timeline, but the nuts and bolts of it is are, there's a universal 10% tariff baseline. For some countries, it's a little bit higher. For some countries, it's much higher, like with China. But on Liberation Day, which was April 2nd, Trump kind of introduced these reciprocal tariffs, which said, yes, everybody's at least got a 10% baseline tariff, but there are some countries that are, going to have a higher reciprocal tariffs based on kind of our trade imbalance with them. Trump has since paused that, but a lot of the things that are in place with China, Mexico are much higher than that 10% baseline. Canada and Mexico, if you remember, going back to February 1st, he kind of implemented those 25% fentanyl tariffs. China, we've had kind of initial 10%, then another 10%, and then it's kind of escalated to 145%. Trump has recently indicated he'd be willing to kind of pull that back, but I think it's going to be much higher than kind of where things have been, obviously.
And Jeff, those are our three biggest trading partners,
That's
which
right.
is the reason he's kind of targeting Canada, Mexico, and China.
Excellent point. Excellent point. And then and again, this is where things kind of get a little kind of confusing. But there are certain items, certain sectors which kind of experience higher tariffs or lower tariffs, exclusions, carve-outs, whatever you want to call it. Steel and aluminum, 25% tariffs. Autos, 25%. I feel like the last couple of days he's kind of talked about maybe carving that out a little bit more. These also get a little confusing, right? Like if an engine's kind of assembled in Mexico, but the parts are coming from all over the globe, how do the tariffs kind of apply? Is it USMCA, which is the precursor to NAFTA? Are they compliant products with that? If so, they're excluded. So there's a lot of confusion, and analysts are kind of working through that. Obviously, the supply chains are going to have to be reconfigured, or there's some confusion about like how all these tariffs are going to be kind of essentially, what the impact is going to be. One of the things that we kind of look at, broadly speaking, like, oh, well, tariff rates on our goods for foreign countries maybe aren't necessarily high. And so why do we have these reciprocal tariffs that are exceptionally high, relatively speaking? That seems like it's not retaliatory. It seems like it's really just pretty aggressive. And what I think the administration would say is there's also a lot of non-tariff barriers. So we might have a 10% tariff on our goods, but the reality is it's very hard for us to export into those countries, right? If you think about something that's as simple as food, for example, the U.S. obviously also has it, but a lot of other countries will say, well, you can't really. We're not gonna allow for your pork to come into our country because it doesn't meet our health and safety standards. That's a non-tariff barrier. That's a way for them to say, look, we're still protecting our domestic pork, farmers, but we're kind of using it under the guise of health and safety, right? Custom processes can take a long time if it's imported goods, which kind of slows down, how fast goods can enter and makes it more onerous. So those are really like, well, look, we don't have a tariff on your stuff. It's like, yeah, but it's kind of slows down the process, makes it more difficult to export to. So that's also something that the administration's focused on. All right, let's get into the economic impacts, because I think this is really what kind of most people are focused on now that we've kind of laid the groundwork here. Here are some of we're in the middle of the earnings season for the S&P 500 or corporate earnings. And so we're getting a little bit of color into kind of the impacts and the commentary. The C-suite executives are really kind of talking about how they're going to approach this change in policy and some of the uncertainty that they're seeing. The first thing is that one of the reasons why most economists don't like tariffs, even though they can have some good things in certain industries at some points, is that they tend to be retaliatory. And what we've seen out of China is that they most certainly have been retaliatory. We saw the initial 10% to 20% tariff on China. China retaliated, and now they're at 125%. We're at 145%. So it very quickly, gets nonlinear, it goes sideways very quickly. One of the fallouts of that is China's basically canceled $5 billion of 737 jet orders, right? So that's a pretty big impact to, a big plane manufacturer in the U.S. The second thing is really China canceling 12,000 tons of pork. They import a lot of our pork. Soybeans, wood pulp, hay, a lot of these things are importing from American agriculture and farmers. They're in a full-blown crisis right now because they just there's not really a substitute to where to export to. right? And these are things where there were orders and now they're totally canceled. Tesla, they just had an earnings call last week, and they were talking about their, China manufactures a lot of electric vehicle batteries that go into EVs, and Tesla specifically. They're having a difficult time sourcing batteries outside of China. So if there's a massive tariff on the batteries that China produces, now Tesla either has to kind of pause production, accept the increased costs and reduce profits, or try and source it elsewhere. If there's no substitution that they can find, it makes it difficult to produce that. Albertsons, second largest grocery chain in America, they're rejecting supplier cost increase as a result of tariffs. They put a 30-day pause and need to authorize any sort of price increases. This is kind of going to be a challenge. Who ultimately accepts that? Is it the supplier? Is it Albertsons? Is it the end consumer? All of these are questions we just don't have the answers to yet. GE Aerospace, Larry Culp, who's a very famed CEO and executive in American business. He's been around the block for a long time. But his estimate is that the tariffs will cost GE Aerospace about $500 million in 2025. That's a pretty substantial hit to profits. Delta, they basically said, look, if we can't buy Airbus planes, if there's a 10 to 20% tariff on Airbus planes, it stops making those purchases economical, right? And shipping, container volume, we've already started to see that really slow down sharply. Business sentiment, it's starting to weigh on business sentiment. High uncertainty, delaying hiring. They won't invest until they have more clarity. And then, do you want to mention this?
This is kind of an interesting, unforeseen consequence. It's a little bit quirky, but it just shows you how the logistics around this stuff and the ripple effects can be very unintended. The consequences are very unintended. So if you think about it, as U.S. imports from China fall, the shipping containers, right, aren't coming in, or they pile up unevenly. And the last trade war in late 2018, early into 19, Midwest farmers had the crops ready to ship out, but there were no containers for them to ship them. And so you have this bizarre logistical kind of bottleneck where the system is so ingrained that we're so used to getting a certain number of containers from China, then reusing them to ship them out. And with that dramatic fall off, there isn't an easy way to replace this number of containers. So it's a very strange kind of example of what people probably aren't really thinking about. And that's going to drive up shipping costs, of course, right? And delay shipments for industry and agriculture.
Okay, so what's the ultimate impact? The reality is the tariffs rates have been in place. They're constantly changing. Sometimes there's a pause. Sometimes there's escalation. It's difficult, and there are estimates that are out there. But here's the IMF. Their estimates, kind of based on where things are right now, is that relative to the start of what people's expectations were for GDP in 2025, you can see on the left-hand side here, U.S. GDP is estimated to be about, a little bit less than 1% lower than what was initially thought. That's a little bit higher than other estimates I've seen, but suffice it to say, you can kind of see how they kind of break it down. Uncertainty. We talked about kind of pause in hiring, pause in investment. The actual tariffs themselves, right? The tariffs kind of serve as a tax increase, at least over the short term. And then there's probably some other types of unrelated sort of things, but are tangential to the tariff hikes. The reality is it's probably going to slow growth down, at least in 2025. At the same time, you've got kind of the inflationary impact from the tariffs that's going to push prices higher, at least in the short term. It depends on, each good is going to be different. Depends if there's another domestically sourced good that's equal quality, same price. All of those things are going to matter, but the reality is, inflation is going to probably be a touch higher. And then if we look at those combination of slower growth, higher inflation, that's not really hasn't been a good combination for financial markets historically. We'll have to see how it shakes out. But that's kind of where estimates are at the moment. One of the things that I think is both a rationale for having tariffs, but also the scary part of having tariffs is the fact that some of the things that are in their supply chain are critical. They're critical to the United States production of pretty important types of products. At the same time, China controls a pretty big, part of that supply chain. One area, and you probably have heard about this, is rare earth minerals. If you look at this list, the number in red, the things in red kind of are where we source the majority of them from. And the reason that these are important is because they impact semiconductors, they impact defense-oriented items. Josh had pointed out to me earlier that they're kind of one of the things that's in night vision, right? If you can imagine our military not being able to see at night, that's a pretty poignant thing to consider. They're also, EVs, missile-guided systems, so on and so forth. So it's a very important part of this tariff discourse. All right, let's get to kind of the state of the markets. If you've kind of been on our calls or read any of our correspondence over the past year plus, I would say we've kind of made a big to-do about the fact that we felt like markets were fairly extended. The chart you're looking at right here is over the last 30 plus years. This gray line represents the price of the S&P divided by estimates for the next 12 months worth of earnings, right? And so we saw this really big bull market in the 90s. Many of you lived and invested through that, where we saw valuations go from 12 times to 24 times, just almost a doubling. And this effectively was a bubble, right? For a lot of other reasons than just valuation. There's a lot of companies that were priced ridiculously high for no earnings at all. And then we saw a compression in that until the great financial crisis. And then the last, 15 plus years have been excellent in terms of we've gotten to valuation expansion. We've gotten the economy's growing at a pretty nice clip. But the reality is, when we were at 22 times forward earnings at the start of this year, we'd only seen that a couple of times in the past, several decades. And we just felt like, the economy was on solid footing. Inflation was coming down. We had this new technological revolution in AI. But the reality is the market was already starting to price that in. We feel like now with the recent sell-off, yes, we've gotten kind of rid of some of that euphoria. We're still kind of on the upper side historically, I think, of that range. And so maybe some unfortunate news is, yes, we've kind of pulled back a little bit, taken some air out of the balloon. But the reality is we're still not at cheap levels in the market. Sorry for that little butterfly. As kind of going back again to the beginning part of the year, why we're a little skeptical of the economy and the returns is, post-election, we really saw an uptick in kind of growth expectations in the economy. You can see that in this green line, which is U.S. GDP expectations for 2025. Kind of starting in the summer, late summer, early fall, we went from 1.7% GDP growth to expected 2.3% GDP growth. That's starting to come down, and some estimates actually kind of come down even since a little bit further. A lot of this is just maybe some over-optimism in the economy that was misplaced. Some of it, obviously, as related to the tariff stuff and what that might kind of impact, confidence. No other place is that euphoria kind of more prevalent than on Wall Street. On the left-hand side of this chart, you see kind of Wall Street banks' expectations of where the S&P 500 would end the year of 2025. We started the year about 5,800 on the S&P, so this represents maybe a 10 to 15% increase in prices in the S&P 500. There's always going to be a range of expectations there, but universally always bullish, right, from Wall Street. This, we don't necessarily follow the, price targets per se, but it's just kind of another sort of data point in the fact that people were very optimistic about kind of future returns in 2025. Now that we've sold off to about 5,500 on the S&P, we've seen the banks follow suit, and obviously they pulled back expectations as is normal for them. But I just wanted to show, I thought this was a pretty nice chart to show kind of how expectations sort of follow price, right? And there's a expression on Wall Street that narrative follows price, and now we're starting to see some of that optimism kind of flow out. Normally, I would say normal times, most businesses are focused on kind of economic growth, inflation, how the end consumer is doing. But I thought this chart was really poignant because it shows kind of the mention of tariffs during earnings calls over the past 20 years or so. And we really are starting to see companies having to pivot and focus more on tariffs. The last time we saw something like this, obviously, was during Trump's first term, during the trade war with China. This is obviously going to be more expansive than just focusing on China. This is going to be, how's it going to impact Japan, EU, et cetera. So, we expect some of this uncertainty to continue. And the reality is, this kind of pulls companies from focusing on product development and innovation and having to deal with kind of geopolitical risks that they weren't thinking about, 12 months ago. One of the questions that we get quite often, and it's become more into focus as a result of the tariffs and the potential inflation, but always, right? I mean, this is always at the top of people's minds. Where are interest rates going, higher or lower? We saw a situation where we were in zero interest rate policy for a number of years since the financial crisis, then shot up to 5.5% Fed funds rate. Now we're starting to come back a little bit, but now we have a tremendous amount of uncertainty surrounding inflation, what's growth going to look like. And the reality is inflation sort of stalled last summer on a year-over-year basis. We kind of came down from the high single digits in 2022 back down to about 2.5%. The Fed's target is 2%, and it's having a very difficult time getting back to that 2%. That was like kind of the last mile, and it's been having a very difficult time getting there. The Fed is we're interjecting a little bit more certainty in inflation expectations, but we think inflation is going to probably rise as some of these inventories have to be restocked with the higher priced tariffed goods. If the Fed sees this as sort of a transitory thing, the deals sort of get struck and then we kind of pivot, the Fed is probably likely to kind of pause and then resume their maybe cutting rates even more. Over the medium term, it's going to depend on the mix. It potentially could be deflationary in some areas like travel and some more discretionary areas. If your consumer staples tend to cost more, you're going to not be able to go out to eat as much. You might not be able to travel as much. All of these things will kind of ripple throughout the economy in different ways. But ultimately, the Fed's uncertainty regarding the direction of inflation is going to probably keep them pausing for a little bit longer. On the other side, we've got the government is there's a lot of expectations about cutting the budget spending right through DOGE, and the initial expectation are around $2 trillion a year. That's since come down. Those expectations are closer to about $150 billion. So, and Trump is trying to kind of talk about extension of the Tax Cut and Jobs Act, tax rates, maybe additional spending cuts, tax cuts, which might inflate the budget, inflate the deficit, and therefore more supply of additional debt. That pressures interest rates a little bit higher. And then lastly, I would say if we're kind of onshoring some of our supply chains that don't exist really in America yet, that's going to result in higher demand for construction materials, concrete, steel. All of those things are commodities that will need to be purchased, and that's going to add to more demand for and inflation pressure. All right, challenges and opportunities. One of the things that we've seen this year which is one of the silver linings, I would say, is we've seen diversification win again, right? I mean, the last couple of years have been like, if you haven't been in the Mag 7 stocks, if you haven't been in US large cap tech, it's felt not quite as good. But the reality is this year is almost the exact opposite, right? Large cap stocks, especially the Mag 7 names, Tesla, Nvidia, Apple, all the household tech names are down in price, and sometimes in some cases very, very significantly. Conversely, you've seen bonds actually eke out a positive return, up a couple percent over just a couple months. That's pretty good. Developed market equity, we look at, everybody's worried about tariffs and the impact on places like Germany and developed economies like Japan. The reality is their stock markets have actually done pretty well and significantly better than the United States. Commodities, we talked about gold, right? All of those types of assets that have been less correlated to the market, but actually have been outperforming. So this is, in our view, has been a great actually witness to why diversification works. Let's put this market volatility in context. I know, we go through these periods where the market kind of just feels like it's gliding on clouds for the past couple of years. That's certainly been the case. And then we go through a period where, from the market peaked in February, on February 17th, and through April 17th was down 20%, right? We're talking about 6 weeks where the market basically goes down by a fifth of its value. In 2020, we saw something very similar. In 3 weeks, the market was down 35%. Obviously, those are pretty crazy circumstances surrounding those. But if you look at this chart over the last 45 years, you can see this line right here, this 20% line. It's almost 20% of the time, 25% of the time, we see markets slide 20% or more for the most part. And in our view, nobody likes to sit through that type of volatility. It's painful, it's scary. But the reality is this: volatility is essentially the toll that you need to pay for those long-term returns of about 10% per annum over a long period of time. It's, again, not pleasant to sit through, but this is not particularly unique to equity.
And there's always the narrative at any point in time during those 20% drops was always very scary, right? Today it's scary, but it was equally scary and felt unprecedented when it happened, whether it's COVID or the great financial crisis. So the volatility is unsettling. We understand that, but it actually is normal, and it does result in opportunities as well.
Good point. All right, so that we've
Potentially so.
Okay. So just one more slide in the market volatility, or
yeah, I think this is a good one.
Yeah. So one of the things that we were looking at is when the volatility index, or sometimes called the VIX, which is the fear gauge of the market, when it spikes high, is that a good time to be buying? That's when everybody's kind of crawling under their desks and not wanting to put cash to work. But this chart shows that each of those little green arrows represent a time when the VIX surged above 40. I'll go through this very quickly, but there's been a number of periods where that's happened, and this past couple of weeks have been just the latest example of that. Over the next couple of months, it's a crapshoot, right? It's a coin toss. We really don't know what's going to happen and how these things will get settled out. But if we kind of look out 6 to 12 months, the likelihood of the market going up is pretty significant and at a significant pace. So we have. I know it's easy to kind of get stuck in kind of the current environment, but if we look out, a year or 2 years, I think we'll be much higher. That's a market-based one. This is a consumer sentiment one. Again, this is this gray line represents consumer sentiment and how happy people are, how afraid people are. And what we see here is basically at each one of these peaks, it shows you what the market did over the ensuing 12 months. So at these peaks, stock returns don't tend to do that well. That's when everybody's excited about the future. Stocks actually are already pricing in that environment. And conversely, when things are down, when people are miserable, when people are unhappy, when people are afraid and scared, that's typically when returns are highest. And right now, we are at one of the lowest points in this survey's history, which goes back about 50 plus years. And the reality is, we don't know, again, what's going to happen over the next couple of months and where stock returns are going to be. But if you look at each one of these low points, we see double-digit returns. And so we're pretty confident that whenever, Warren Buffett says, when stocks are the only thing, when they go on sale, everybody runs out the store. This is a perfect kind of, I think, illustration of that. All right, markets look forward, not backward. The market is a leading indicator. A lot of times there's confusion on this, and I'll go through this very quickly. The market is anticipating changes in economic data about 6 months in advance. It is not perfect, but oftentimes markets would bottom when things still feel terrible. I remember during COVID, people were like, hold on a second, like there's still mom and pop shops closed on the street. Like, how can the market be advancing? And the reality is it's kind of looking much further ahead than I think most of us can, right? And sometimes even just when there's the second rate of change, things get less bad. That can spark new, crazy, powerful rallies before things actually really feel good in our own personal lives. If you're one of those investors waiting for good news and the all clear to kind of put capital to work, put cash to work, get back in the market, sometimes you miss the most powerful and strongest part of a rally. Let's just go through a couple of examples. In 2008, the market bottomed March of 2000. Does anybody know when profits bottomed? Not for another couple quarters, right? And so if you're waiting for companies to start earning money again, guess what? You missed on a pretty significant rally off the bottom. Same thing with COVID. Again, stocks bottomed March of 2020. Does anybody know when hospitalization peaked? Then took another 9 months. Right, so if you're waiting for hospitalizations to kind of get under control, you missed, again, a pretty significant rally in the stock market.
And I would say, just to add to what Joe's saying, this is the most common, I think, misconception amongst investors, clients we work with is, again and again, we hear, well, let's just wait until we have kind of the all clear or there's more clarity, things have settled. And we understand that perspective. It makes sense. Unfortunately, it's just not really the way the markets work. And we're trying to give you examples where, like, you actually, if you're looking to be opportunistic, like Jeff was saying, just to summary, when volatility spikes, sentiment drops really low, the market's down 20%. Historically, that's been a really good time to put money to work in stocks for future, not only for just future returns, but also your risk after all that's happened is lower. Right, that you're getting in. It's just not intuitive. Very, very hard to wrap your mind around. But here's some, these are real examples, 2022.
I'll give you the last example. Market bottomed October 22. Everybody's saying inflation is going to be high forever. The reality is inflation peaked June 2023. So it took a while for inflation to peak, but the market was well ahead of that, right? And so that's what makes this investing very challenging. But to Josh's point, you always have to be investing purposefully in that uncertainty and running towards it. And so far, we've seen the bottom in stocks on April 7th. Escalatory tariffs with China kind of peaked a couple of days later. Does the market know something we don't? I don't know. It could be very confused. There's a lot of sort of things that are happening. But the market is smarter than a lot of us. And so we kind of have to.
And it also acts as a restraint or constraint on
that's right.
Politicians, even if they don't want to acknowledge it. I think, there's there's the invisible constraint of what's happening in bond markets, what's happening in the stock markets, and they can ignore it for a while, but at some point, and I think that was part of the reason for the 90-day delay, was the market was just in free for all, right? And initially it was like, oh, it's no big deal, but then it's like all of a sudden you get enough carnage like that, and it does trickle into the real world for sure. The market's just always going to be the first.
That's right. One of the areas we're kind of seeing some silver lining, go through this quickly, is Europe. Europe for a number of years, especially post-Great Financial Crisis, have limited how much money governments were able to spend. They've since sort of kind of removed those constraints. And a lot of things, the poster child for fiscal austerity was Germany. They're very, tight on their budget. They've launched a new, $1 trillion investment plan. The EU is committed to 800 billion to modernizing their industrial sector and committed to more defense spending. And so, this is an area where we think the U.S. maybe kind of fiscally, we've already spent a lot of money, and so we may be kind of pulling back on some of those budgets, whereas kind of Europe is picking up the baton. That might be an interesting place, to be looking to make investments. So
just an interesting fact, right? Germany is doubling its defense budget to levels that we've not seen since the 60s, right? So it's taking over old plants that had been defunct, shut down, and they're being used as production plants. So it's a little scary given the World War II history, but in this context, I think it's a good thing. So yeah, we're going to get to questions, and we're happy to go a little bit over. There's a lot of information, so we've done our best to, get it to you in a concise and impactful way. So I'm sorry for going a little bit over here, but basically, the final slide is like over the last 15 years, index funds, Vanguard index funds, BlackRock index funds, just index. All you hear about now is index funds, index funds, index funds, which is basically just a way to invest cheaply and passively. And it's worked tremendously well because you had Facebook, Microsoft, Amazon, Google, and Apple drive a huge portion of returns, and they got bigger and bigger and bigger. And as they got bigger, they actually got more profitable. There wasn't this reversion to the mean like you'd seen traditionally as companies got bigger, like Intel, Cisco. So they've dominated. But I think it's it's fair to say, based on the geopolitical environment, that the environment is changing. We're not saying that U.S. exceptionalism is dead by any means. We don't think that it is, but the world's becoming more complex. Inflation, right, is no longer zero. Tariffs are introducing all sorts of uncertainty. A lot of world leaders are focusing and emphasizing and want more deglobalization, right? More populism movements. Higher interest rates are reshaping winners or losers, and even within the market, right? There are winners in areas like defense and utilities and biotech that are emerging. Market leadership's emerging beyond just big tech. So we think stock selection, sector flexibility, analysis of bonds through credit analysis matter more now than they have in a long time. So it's not to say passive doesn't have a role, but we absolutely think it should be complemented with active management. And as many of you know, probably core holding, our biggest core holding is a T. Rowe Price fund called T. Rowe Price Capital Appreciation. I think David Giroux manages that fund. He's been managing since 2006. And I would say that's the poster child of stock selection, sector flexibility, asset class flexibility. And, probably the best and easiest example is, that fund can hold cash and treasuries, and it can own stocks. And during COVID, late March, they put $9 billion with a B, to work in that fund because they were looking at companies like Hilton and Marriott and seeing they were trading at extremely, extremely depressed levels, and they had the balance sheet to get through to the other side of COVID. And he was seeing rates of return in excess of 25% per year, put a ton of money to work, but they had to have the cash and the flexibility to do that. So I think, these types of markets that we're going to see now going forward with higher volatility, more disparate outcomes across the globe, it's ripe for active management. And like Jeff said, even keeping an open mind to developed international investing, we think makes more sense now than before. So why don't we turn it over to Q&A? If you've put anything in the Q&A box, we can go ahead and grab that. Let me see here. See it there. Yeah, thanks. So we don't see any questions yet. So now's kind of a time if you have questions. I know there's a lot of you on here. Please go ahead and put those in the Q&A, and we can go ahead and read them off. if we answered all of your concerns and questions, that would be great. But my guess is and by the way, if you don't want to have your name shown, you can click anonymous. Otherwise, it will show your name. But yeah, any questions you have at all on anything we covered or things you were hoping we would talk about that we didn't, we can do our best to address that. Yeah, it'll pop up. Anything else on your mind other than what we kind of
I think we
talked about?
covered a lot.
Okay, yeah. There's a lot of information. I mean, the market, right, it has been really volatile. It's been a little bit more stable recently. But I think a lot of this is just going to depend on, at least the moves day to day is going to be, what, headline news and markets moving and trying to figure out what's going on. But it hates uncertainty, and there's a lot of uncertainty right now. Okay, we have a couple questions coming in. So we'll go ahead and open those. Okay. Well, why don't we start with the one? So yeah, one question is on making withdrawals from 401ks. I think, right, if you're talking about making withdrawals from 401ks or from IRAs, if you've been working with us, right, you don't have everything in stocks. And so I think it's okay to still take your withdrawals from your investment accounts because they're not all in stocks, and bonds have actually been up year to date. Cash is positive and yielding. So I think as long as you target those areas while a sell-off's happening and take from there and just defer not selling stocks to generate the cash needed, I think that should definitely be the priority before turning to any sort of alternate source, especially a HELOC, which is going to come with very high interest costs today. Another question: what sector and stocks represent good value in the current climate? We're gonna maybe not go into individual stocks, but in terms of sector exposure, we would say. Okay, and then we got another question. Thank you. So probably I would say a sector that comes to mind that's attractive, kind of over a multi-year time frame, based on valuations. Revenue growth, earnings growth would be healthcare. Healthcare tends to be non-cyclical, right? It would be more recession resistant. The valuations in healthcare are cheaper than the overall market, but a lot of healthcare companies still deliver, high single-digit revenue and low double-digit earnings growth. So that's, again, on par or a little bit higher than the market. I think when tech was down 20%, that was an interesting time to maybe nibble there, but it's challenging because there are some parts of technology are more fairly valued, and then other parts are still kind of pretty rich.
I would also say maybe utilities. Utilities kind of benefit. They don't have a lot of foreign exchange risk. They're mostly domestic. So that kind of be exposed to tariffs, number one. Number two, I think if we're going to see kind of a resurgence in manufacturing, reindustrialization in America, the limiting factor, not just with that, but also with AI, is electricity generation and power generation kind of more generally. And so if you look at, China has 2x the amount of per capita electricity generation than the United States does. There's no doubt we need to rebuild or build out additional infrastructure. I think utilities kind of have to be at the center of that, at least in America.
Explain the upside of tariffs. So, the reason tariffs are used and the upside, one is it is a way, if done successfully, to generate additional revenue. And I think part of what the administration is trying to do is to generate additional revenue to maybe not only extend the tax cuts, but maybe, cut taxes more, maybe in the corporate sector. The other thing it can do, right, is because countries are so dependent upon us spending money to buy their goods and services, they might be more likely to come to the negotiating table to kind of reassess what their tariffs are on us to make things a little bit more equitable, right? So I think that's been fairly well broadcasted that these are the reasons that this is being done. But hopefully, in going through the slides, you got a better understanding of why the trade deficit is what it is, why these foreign countries are buying US dollars. It's a big reason that we've been able to enjoy such a low cost standard of living. So it's not they're saying that it's only bad. We're just saying this is a massive change and departure from anything we've seen in recent history. And the world over decades has gone in a way of, right, each country having its own specialization and doing it at a low cost, doing it very effectively. And now a lot of that could be unwound.
Yeah.
A good example is, these big companies have, we were talking yesterday, airplanes, cars, they have tens or hundreds of thousands of suppliers in their supply chain. If you take a company like Boeing and one of the niche products that it's buying from a supplier, that supplier goes out of business because of tariffs, they can't just go to another supplier, right? They got to get approval from the Department of Defense. They got to make sure that the cost is the same with the new supplier. I think it's hard to appreciate the nuances that go into the economic impact and decision making that take place as a result of some of these things. What is the expected impact from increased energy generation and export? Maybe the increased demand of energy, like with AI and data centers?
I'm not sure what the question is.
Not totally sure of the questions. We'll come back to it if you want to rewrite it, maybe. Do you think a recession is likely in 2025? It depends. I think what we would say is recessions are often forecasted by Wall Street, celebrity CEOs, economists, but they're very rare. I think they only happen maybe in the post-World War II area, 11%.
7%.
Yeah, 7% of the time. Like everybody was forecasting for a recession in 2022. Guess what? Didn't happen. People were forecasting recession and a much worse recession than what we had in 2020 as a result of COVID, like the biggest Great Depression ever. We had one quarter, it was a massive contraction, but then basically reverted. 2018 with the trade war, it was recession. People talked about recession, didn't happen. 2011. What is interesting is we've had some rolling sector recessions, and that could happen. So right in 2015, 2016, we had an energy, you could argue an energy recession with the price of oil plummeting.
Yeah, I would say another weird quirk of the tariffs and kind of front running the tariffs is the fact that people kind of rushed out to import a lot of things that they thought might be subject to the tariffs. The quirky thing about kind of GDP, I think this is imperfect, but a lot of people sometimes talk about GDP, 2 negative quarters consecutive GDP kind of defines a recession. That's actually not how a recession is defined. But let's just say you take that for the definition. You might see a quarter of negative GDP just because so many people have been importing foreign goods, and that actually pushes down GDP growth. So there could be some weird statistical quirks, and you might see some negative quarters of GDP growth as a result. But look, I mean, the consumers people are continuing to consume. We talked about the deficit. The deficit's still pretty high. That's supportive of profits and supportive of spending. So it's going to take a pretty sharp, I think, kind of sudden stop in kind of foreign global trade for something like this. But you could definitely see a period, a month or two, until things kind of get worked through where things are sluggish.
Yeah, so we can take the next few questions at what effect will reduced spending and the debt have over the coming year? isn't the impact of tariffs a short-term impact on the markets? What is the expected impact from companies building plants in the US? So we're really, what's interesting is we're not really spending less.
No.
So as a country, we're not spending less. The deficit continues to run high. The tariffs, the goal of the tariffs and some of the cuts to the federal government were, like we said, it was supposed to be 2 trillion of savings, and now they're saying 150 billion. So not quite, I think directionally trying to cut costs, but it probably not as big as they had hoped. The impact of tariffs is short term, assuming the tariffs are short term. But if the tariffs stay in place, like if we're in this game of chicken with China for an extended period of time, everybody I think, is going to suffer, right? They're going to suffer. We're going to suffer. Is that going to happen? I personally don't think it will. I don't think it's going to be that prolonged because I think there are constraints, right? There are constraints, and the bond market has spoken loudly. The stock market spoke loudly. The currency market is speaking loudly, right? The dollar's depreciated, 15% or so relative to the euro, 10% relative to the euro and other currencies. So, those things seem like they don't matter maybe in the eyes of the politicians, but they absolutely do. I just think the amount of pain that would be incurred would be more than what the politicians could bear. And that's my opinion. I may be wrong. That's my opinion. What is the expectation? So we can talk about these companies building plants in the U.S. to onshore supply chains.
Yeah.
Doesn't take months.
No, it takes a couple of years.
Takes years, yeah. Right? So.
Yeah, I think
and it's a huge decision for a company to make. If they think the tariffs are going to be paused, they may just freeze.
Right. That's right. So if you put yourself in the shoes of somebody that's making, $50 million, $100 million capital allocation decision to kind of build a new plant in the United States, that's what we call like a long-lived asset. That plant's going to be there for decades. And if you're not so sure that the tariff policy could shift over the next couple months, that also is going to impact kind of like how economically sound that decision is going to be. So you have to be pretty certain this is going to be like a final decision. And then on top of it, so that's going to take a couple of years to kind of build out that, we need infrastructure, we need good roads, we need electricity generation, all these things. Then we need to train the workforce. It's not impossible. I think, the thing we always come back to is like, we showed that chart of manufacturing jobs as a percentage of total labor force. It basically goes back, 75 years. And so it's not necessarily a question of, these countries are ripping us off, or, there's definitely elements of that. I don't want to say that it's never the case. But the reality is, 20, 30 years ago, 40 years ago, it took 10 man hours to produce a ton of steel. And now it takes one. A lot of that isn't necessarily from China or Japan ripping us off. It's more the mechanization and automation of a lot of these processes. And that's enabled us to pursue other more service-oriented, higher paying jobs, higher margin jobs, which have kind of benefit the economy. I'm not saying it doesn't behoove us in certain sectors to kind of bring some manufacturing back, especially when it relates to pharmaceuticals, things that are kind of related to health and defense and some of those critical industries. I just think we're not going to go back to probably making T-shirts and blue jeans in America. I think that's probably clear.
It increased export of natural gas and pumping more oil should have a positive effect to the economy. So it's a question, also comment. I think it's important to remember how our economy is driven. It's driven 70% on consumer spending.
Yeah.
Well, I'm just
talking. Yeah. Look, one of the best things that's happened probably over the last 10 years is kind of the fact that we've had this oil renaissance in America, and we're net exporters of energy. And that does a lot of are good, I think, for our economy. One is we control the production, we control, enables us to kind of control kind of oil prices at the pump, which helps consumer confidence, inflation. Uh, and it's also not, it's a national security issue. We don't have to really rely on OPEC and all of those other types of countries out there. So we'd agree. Look, America, one of the parts of American exceptionalism is that geographically is the best possible country you could ever think about having. We have massive oceans on both sides that protect us. We have wide swaths of land that we can farm, and we have large navigable rivers with deep ports. All of those things are fantastic. And then we found the shale revolution where we have like these large deposits of energy basically underneath our feet. So agree, that is one of the sources of American wealth.
Given the uncertainty, what do you think it will take for U.S. business to invest in U.S. manufacturing? And given AI, what would the impact on employment be in those new factories? It's a great question.
Yeah.
I mean, I think for businesses to invest, unless they're being subsidized by the federal government, they have to see a return on invested capital that's in excess of what they can earn by putting that money somewhere else. And there's no question. I mean, I think already a huge portion of U.S. manufacturing has AI embedded through robots and automation. AI is going to continue to get better. The automation is going to continue to get better. So certainly, to the extent, I think it's not that dissimilar to why, with the energy renaissance. Like, frankly, the technology of fracking allowed these companies to get access to oil and natural gas that previously they couldn't in an economically feasible way. Well, if AI develops enough where the cost of making these robots and automated manufacturers, like it brings the cost down enough, they're going to do it. Now, what would the impact on employment be in those new factories? Well, you probably wouldn't have as many people working in those factories, but arguably those are people working in those factories that either aren't working now or in another industry that was displaced. But AI is going to have, over the intermediate term, a dramatic effect on the labor force. I think, ironically, a lot of the impact is actually going to be on software developers, because the real data point we have now is that Microsoft GitHub Copilot, which we've talked to a lot of you about, has shown to make software developers 20-30% more productive. Well, that's only going to go up over time, and the more that goes up, the less companies need software developers, right? They need one instead of two. Well, that could lead to a lot of software developers who are out of jobs, right? So they basically created the code that arguably could put them out of work, which is kind of unfortunate. But and other customer service industries, right? You're already seeing more automation when you go through drive-throughs. AI in general is going to have a dramatic impact on unemployment over the intermediate term and just the composition of the labor workforce, I think.
And I would say one of the criticisms against China from kind of domestic point of view is that China is very open about kind of subsidizing and pushing capital into some of their domestic exporters and businesses. Huawei being probably the most prevalent example. In America, that feels like providing subsidies, corporate America, it feels dirty. This is my opinion, is I feel like at some point, we've gone from kind of a strong kind of federal state like 100+ years ago, then kind of the rise of corporate America. We're kind of seemingly shifting towards a more powerful, federalized, centralized kind of system of government. I feel like we're probably going to need more things like the CHIPS Act, more things like that to kind of have that manufacturing renaissance. Because the reality is, with tariffs probably are not the best answer for this. And the reality is globalization is hard to really kind of combat that without sort of incentivizing corporate America from a profit standpoint to invest onshore.
And the reality is, a lot of these things that the government may need to subsidize, there's still the issue with the budget deficit, right? The trade deficit's a very small portion, but the budget deficit is really a result of, right, our spending being far more than what we're bringing in tax receipts. And if you look at the budget, I think it's 60%. 60% of the budget is basically Medicare, Medicaid, and Social Security. And so some of that they're looking at is fraud around that. But a much bigger part is just that the way Social Security was set up was they started taxing people in 1935 who were working to pay beneficiaries who had already retired. So it was never like, okay, you're paying in and then your money is going to be there for you. It's always dependent upon the next generation. And if they just did some simple things, in my opinion, and we're not politicians, but I'm just saying, like, we have to be willing to look at those programs in a real way if we're serious about bringing the budget deficit more in line. And one of they can do a lot of things, pushing their Social Security age back, raising the wage, right, at which Social Security is taxed. I mean, just going from, I think, 180 where they're at now to 300,000 would have a significant savings to Social Security. So, it's great to want to do all these things, but I think, the tariffs kind of are one way to approach it and could work, but without any kind of serious conversation around dealing with, how we're funding these entitlement programs, what they look like over time. It's going to be hard, right? There's just only so much room you have. Right now, I think we're still kind of, nibbling at the margins, honestly. But there's just not enough political will to do anything.
Agreed.
Thoughts about the DC area residential real estate trends? So I guess the question there is, you're having more and more federal workers who are, either resigning or getting riffed. A lot of uncertainty. And so I think the question is, well, if you have enough of these people losing their jobs or there's enough uncertainty, could housing prices in the DC area decline? Potentially. I still think there's a supply constraint, a fairly big supply constraint with housing in the area, in the country in general, but also in the area that would provide some level of support. But I guess the answer is possible on the margin. Maybe it doesn't rise as quickly. It's hard to see a dramatic decline unless the amount of layoffs increase exponentially. But a lot of these buyout offers and early retirement offers, they're being accepted, but they're being accepted because the person chose it, which means they're probably coming from somewhat of a place of financial stability where they don't need to sell their house.
Right.
I would defer that to a DC, a realtor in the area who's kind of got their pulse on the market, though.
Yeah, agreed. Agreed.
A lot of questions, a lot of good questions. Are there any other questions while we're here? I know we're way over, but this was a very widely attended webinar, and really happy we're able to do it. Hopefully it was helpful, and if you have questions that you don't want to ask in this forum, you can feel free to email any of us, Jeff at 4J Wealth, Josh at 4J Wealth. But we really appreciate and are grateful for your time and your questions, and we really hope that this was informative. So thank you very much. Bye-bye.
Bye.